It's all those things, margins, clients. In the banking business, the character of the clients you have will reflect on your bank. So the first thing is who are you doing business with, how are you doing business, and and also making sure your compensation plans aren't paying people for stuff which is stupid or unethical. And and you always have to review these things to make sure you have them right because they change all the time.
All right, David, so catch us up to the merger.
So you run Bank One for 4 years from Chicago, and then in 2004, you merge with JPMorgan Chase in what is termed at the time a merger of equals. I think JPMorgan Chase referred to it as that. Bank One shareholders get 42% of the combined company. I mean, I think people don't realize how much of JPMorgan Chase is Bank One today.
That's why it's a little irritating to me when they say you've been running it since I was running JPMorgan. I was running 40% of the company for the whole time. And when I got to Bank One, and I'm not working around the clock, I already knew that a logical strategic merger might be JPMorgan. Okay, I know all these companies, and that's the other thing about Fortress balance sheet is you also have real strategies that survive the test of time, and you're not flipping and flopping. And then I'm sitting there, and across the tape comes JPMorgan and Chase to merge. So we're worth like $25 billion. They're now worth like $80 billion or 90 or whatever the number was. I'm like, well, there goes that dream. But 4 years later, our stock was up to, doubled or something like that. Theirs actually come in, and it was in the target range. And I had been meeting with Bill Harrison, the current chairman of JPMorgan at the time. We were talking about it. We both knew it made business sense. They were kind of looking for a CEO. So we had been talking probably for a year and a half before that.
They're looking for a CEO. Did they give Bank One shareholders 42% because they were looking for a CEO?
There were 2 lawsuits. Okay, so we got the premium. They got the name and the location, and I effectively had kind of control from day one, because inside the merger agreement, and this is almost unheard of when we get the premium, is that to not have me become CEO 18 months later, 75% of the board would have to vote me out. And the
default was you were going to become CEO.
And the board was 8 Bank One people and 8 JPMorgan people. And I knew a lot of the JPMorgan board members too who respected me. And Bill Harris and I were very close. But that was the agreement. They got sued for paying too much to buy me. I got sued for not taking enough. You get sued. You can't win in these.
I think every shareholder is probably.
But it worked. It worked out.
Yeah.
All right. 2006.
Before we get to 2006, when you were going through that process, and even maybe the couple of years before you and Bill were talking, you're starting to think about JPMorgan as a partner. I'm curious, did the name JPMorgan factor into your thinking at all? Did you view that as an asset?
I mean, JPMorgan brand is a Tiffany name. I didn't value it in the deal. And what I looked at, I had given my board, I think the first thing is run your company well. And people thought I was going to start doing deals immediately. I was like, no, we suck. We haven't earned the right to run someone else's company yet. When we're running a good company, we can merge with somebody. But the first thing I looked at was business logic. And that every business, we had a consumer business, they had a consumer business, we had a credit card business, they were both terrible. They had a credit card business, they had a big investment bank, we had a big US corporate bank that needed some of those investment banking services. We both had a wealth management business. I knew we could save a lot of cost saves, so the business logic was pretty impeccable. Then there's the ability to execute. Like, can you actually get it done? Because you've all seen a lot of deals where they fall apart. They don't have management, they don't consolidate the systems, they have infighting, it kind of happened at Citi, and so you don't effectuate, and then there's the price. So I knew we had a Tiffany brand, but it didn't value, because if everything else didn't work out, I don't think it would have mattered that much.
Interesting.
All right, so I'm going to fast forward us a couple of years. It's 2006. Yep. You're officially chairman and CEO of the combined JPMorgan Chase.
And 2006 on Wall Street is like
go,
baby. It's like 1980s all over again.
It was.
I think you had the same incentives as everyone else, but you behaved very differently. Am I missing something? Did you have the same incentives, or
you pulled JPMorgan back hard on the risk side in 2006?
I did. So there were cracks out there in 2006. You may remember the quants. There started to be a quant problem, and in 2006, we definitely saw subprime getting bad. And I pulled back on subprime. I wish I had done more, because if you look what I did, you say, okay, well, you saved half the money, but you would have saved more.
Yeah,
still
you
lost-
still had some losses.
Yeah,
$5 billion?
but we also had, I'm going to say less, maybe a third of the leverage of the big investment banks, and a lot more liquidity. So in 2006, I started to stockpile liquidity, and looking at the situation, I was quite worried. The leverage, if you may not remember this, but the leverage, because of accounting rules and Basel III, Basel I, investment banks, particularly the banks, the big investment banks, went from 12 times leverage to 35 times leverage. And it was go-go.
So for every $1 I'm
CMOs,
putting in,
bridge loans, the whole thing. Like in 07, the bridge book of Wall Street was $450 billion. Today it's $40 billion. JPMorgan can handle the whole $40 billion today, though we're not the $40 billion today. And they were much more leveraged deals. And a lot of them fell apart, collapsed, and then of course, and that was before you had the collapse in the mortgage markets, which really took down a lot of these banks.
But you did have the same incentives, and you had the same access to information that a lot of these other folks did, but you didn't blow up. What explains this? Because usually behavior follows incentives.
Yeah. Well, first of all, if you work for me, I would tell you, I don't care what the incentive is. Don't do the wrong thing, and don't do the wrong thing to the client. If you treat yourself, if you're the client, how would you want to be treated? And I had gotten rid of. I mentioned that one risk thing. There were multiple risk things like that. They were being paid to take the risk. So
You were telling us about the auto loan business.
Yeah, but they would be being paid. But the second I put in all these new risk controls, all of a sudden you weren't making money by taking that leverage, because I was looking at how much capital can actually be deployed if things get bad. And so I was looking at earnings through the cycle. But very importantly, all of these investment banks were doing side deals, private deals, 3-year deals, 5-year deals. I got rid of almost all of them.
This is for comp
Almost all
with
of
senior
them.
bankers.
And so today at JPMorgan Chase, there are no, we do things, and I know some of my partners in the room here, but we all know about it. There are no winks, there are no nods, there are no side deals. There's almost no one paid on a particular thing, because if you're paid on a particular thing, you can do the wrong thing. And meanwhile, you're not helping the company, manage its risk or something like that. So we changed the incentive programs, and I'm quite conscious about incentive programs that they don't create misbehavior. But it's also very important, if you're in a company and you say the incentive program is doing that, you should tell the company this incentive plan is not incenting the right behavior versus the customer. And a lot of it was leverage. So if you look at the leverage in some of these securitization books and mortgage books, if you have 30 times leverage and you're getting 20% of the profits, you'll go to 40 times leverage. It's literally add 25% to your bonus. And so I got rid of the profit pool of 20% and the leverage.
So yeah,
and I lost some people too in the meantime.
It's funny, yeah. JPMorgan as part of the system had the same incentives, but you changed the incentives for
pretty much.
the team within the company. Okay. All right, we got to go to 2008. March 13th?
2008.
Thursday, 2008.
Yeah.
It's Thursday night. You get a call from Bear Stearns' CEO. The stock closed that day at $57 a share. It's like $150 a couple months before. 3 days later, God, I remember it like yesterday. I was working on Park Avenue in Wall Street. I remember that night, $2 a share. You're buying Bear Stearns. Tell us the story.
So I was at Avra on 47th Street with my parents in my parents' favorite restaurant. My whole family was there. It happened to be my birthday. I don't normally get emergency
Happy
phone.
birthday.
Yeah. And Alan Schwartz, who was the current CEO, we'd seen their stock go down. I knew they had some real problems because we saw their hedge funds and some of the things that were taking place there. And he said, Jamie, I need $30 billion tonight before Asia opens. To which I said, I don't know how to get $30 billion for you. And have you called Paulson? Have you called Tim Geithner? So we all called. I called up the management team. I went back in. I probably had a bite and said goodbye. I went back to the office. Probably had 100 people come in that night. They all got dressed. They went back to work. It's emergency. We now rang all bells for emergency. Bear Stearns went bankrupt. Spoke to the Fed about, let's just get them to the weekend. We had one day, and we needed Saturday and Sunday, and we concocted this loan. So we couldn't lend the $30 billion, and the Fed technically couldn't lend the $30 billion, but the Fed can lend to us technically, and I can technically use the collateral of Bear Stearns so that, so we got literally a one-day loan. And then the next day we had thousands of people come in due diligence, and we went through every loan, every asset, every balance sheet, all the derivatives, all the lawsuits, all the HR policies, like real due diligence, a 2 or 3 day period. and bought the company at that night, $2 a share. Hank Paulson was saying, "Why are you paying anything for it?" I said, "Well, I do have to get shareholder votes," and which
Right,
became.
because you need bear shareholders to approve the deal.
It was a public deal, and the worst part of it is I was going to get the lawsuits from the bear holders.